Welcome to Market Call. I'm Morella Fernandez. Thanks for joining us today. Michael Hakes on the show. He is a senior portfolio manager at Murray Wealth Group, and he's taking your questions today on U.S. and global stocks. Here's how to reach us. Call us toll free 1-855-326-6266. You can also email us, marketcall@bnnbloomberg.ca. Michael, thanks for coming in today. We got some new job numbers in for Canada. Unemployment has ticked up. An expected plunge in manufacturing. I would imagine this is widely expected. Do you think it could get worse?
It definitely could get worse. We're seeing the early effects of a once-in-a-thousand-year president here in the States. We are seeing all sorts of repercussions of that. If we look at back to the U.S. in terms of the Q1 numbers and what companies were doing in terms of projecting into the second half, we saw the auto companies all pull their guidance with GM and Ford and Stellantis. And the same thing with the airlines. Delta and American Airlines all pulled their second half guidance because the visibility is almost zero for them. And specifically, some companies have also talked about not pulling guidance, but saying it's very, very murky for the second half, being Amazon, Walmart, even Mattel said they have no visibility into the second half, and we should all expect just to buy one Barbie versus six.
Well, that was the warning from Mr. Trump, right? We all need to have less Barbies in our lives. So I'm wondering whether you're seeing things beginning to unwind in the back end of the year now that we've heard at least some sort of outline of a trade deal with the UK from Washington, talks with China on the weekend, which seem at least to be going in the right direction as opposed to not going anywhere at all. Yeah,
that's the crucial part is we're slowly seeing the U.S. walk back all the extreme reciprocal tariffs that they announced on Liberation Day. And now we're actually getting some discussions with other countries, and you mentioned the UK and China. And I think we have about 193 countries to go after that. So it's a long road, but it's directionally correct. And from there, we should hopefully see some more stability to the markets.
We're hearing, though, that damage is already going to be done, right? Even if they walk it back today across the board, some of this is already too forward. The forward motion is already too strong. So what do you see happening the rest of the year?
So the critical things are going to be for the consumer, and there's going to be pass-through of tariffs, whether it's 10% or 50%. It's just a matter of who bears that cost of the tariff, where it's the origination of the manufacturer in another country, or the importer, or the consumer. Some of it will be passed on. Prices are going up, and the effect on the consumer will be to be seen. But they'll slow down. They may see layoffs tick up. So inflation is going to be coming through. Layoffs will be going up, and then what the Fed does on the back of that, whether or not they tolerate the inflation as a one-off, but they really focus on labor in terms of their metric, in terms of whether they're going to guide down or not.
What did you think of Jerome Powell saying he's still in a wait-and-see mode? He wants to see some of this unwind.
He really differentiates between his role and the government. He says, I'm here to make sure we have full employment and inflation is around 2%. And the policy is on the government. And he's really waiting for the hard data. He's not anticipating, because of what we brought up earlier, is that all these tariffs are in flux. We don't know where they're going to land, and he doesn't know where they're going to land. If he cuts by 50 basis points tomorrow, I think Trump said today it'll be fuel on the fire. Like, that's exactly not what you want. Yeah. You want something to be very
steady.
Thank you. Yeah.
Just rolling along. Okay. Yeah. We are going to take a break. We're going to line up some questions for Michael Hakes. We're back in just a moment. Stay tuned. Welcome back to Market Call. Thanks again for joining us. Let's start with an email today from Lucy. She says, hello, can Michael tell us what he thinks of Sony Group? Haven't talked about Sony in a long time. What position are they in these days?
Yeah, the last time I talked about Sony was when I had my Trinitron TV and I had that special button.
Okay.
But Sony has changed a lot over the years. And if you look just a decade ago, I think their business mix was music, movies, and gaming, and that was like 60%, or no, actually lower than that, about 30% of their revenues. But over the last 10 years, those three segments have gone up to 60%. But Sony has this kind of weird structure where they also have Sony Assurance, Sony Insurance, Sony Banks, and Sony Semiconductors. So it's a sort of a conglomerate. And that's really been the issue with them, is in terms of this conglomerate discount that they've been attributed to. So a lower valuation. But there has been a light at the end of the tunnel when they've been talking about splitting off that semiconductor business, which would alleviate that conglomerate discount. And that's really the catalyst that you could see in the future, where they split off a low ROIC business and then the overall Sony business, which is gaming primarily, and then all music and movies, the valuation would go up to more peer-like valuation metrics.
How do they do in insurance?
It's a very tiny thing.
Okay.
It's not even on people's radars, but this is part of their overall reporting structure. And
would you sort of put money into Sony at this point? It sounds like they're fragmented and have to sort of pick a direction.
If you believed they actually were going to spin off, it could be a small 5 or 10% uptick in the stock, because it'll move towards their Electronic Arts as a competitor with theirs, and Take-Two, more gaming stocks, and they may get that sort of multiple lift.
Got it. Okay, let's go to the phone lines then. We have John on the line, holding from London, Ontario. Hi, John.
Hi, Marilla. Hello, Michael. 3 of the Mag 7 stocks have rebounded after the descent over the past several months. Meta is still $120 from its high. Microsoft, $20 from its high. Tesla, well, it's got Elon back. What's the next Mag 7 stock to rebound? How about Google that's cheap, or how about Meta? Thanks very much.
He's almost asking you to will it to happen here, I think, Michael.
I know, John, what a question. Do you have the next 3 hours and we can chat about that?
Yeah.
There's a lot to cover there. You're right. I think, Microsoft, as part of that Mag 7, was not down nearly as much as its Mag 7 compatriots there. So it fared very, very well during the downturn, and it reported great numbers last week. Tesla was down the most because Elon Musk has been slamming his own brand.
Yeah, there's been a wind-up there.
Huge wind-up there. And actually, Musk should probably leave the company. The board has been debating that for quite some time, it seems. So that's every company you've mentioned on the Mag 7, and no one's quite sure who's still in that Mag 7, who's falling off, who's coming in. But I would say that in terms of positioning, we own Meta in our global growth portfolio. We own Amazon, we own Google, and we own Microsoft. And we're very, very positive on all those, just based on the whole generative AI trend. The most controversial of those names is Google and Alphabet. Yesterday, there was news reports that Apple announced that they're seeing
an AI search engine.
Yes,
right?
They're seeing queries down on my iPhone for the first time in ever 20 years, and that really struck a negative tone to Google. There's been a lot of talk about that.
I was going to say, it's expected to go that way, where the AI queries overtake your basic Google search.
So there's some stats out there, but they're uncertain. When you look at queries on a daily basis, there are 5 trillion queries every day.
That's eye-watering.
And of those 5 trillion queries, only 20% of those are actually commercializable, or they have paid search for. So that's really the bucket that is for Google is in jeopardy. As everyone tries with ChatGPT and Gemini and Perplexity, we all are searching for maybe a better response, and Google also offers that with their offering too. So that's exactly right. So you don't know over time. There's going to be more competitors. Pricing may come down on the Google platform as they try to continue to give a good price for their click-throughs. So that's the big debate on Google. But it trades at only 15 times earnings. So a lot of that is baked in at $150, $155. We see it as good value here.
Got it. Okay, let's go back to an email. This one from Peter. He says, with the cut of the dividend, is BCE finally a buy? BCE is a parent company of this channel, as well as the CTV National News, CTV News brand. And they announced a big 56% cut to the dividend yesterday, which was not entirely unexpected, right? A lot of analysts wanted it to go this way.
Yeah, it's been quite a story. We have owned this BCE in the past in our income growth portfolio, and we've been debating this dividend and how much of the dividend was taking up their free cash flow over time in the last 2 years. And the management team has been adamant that they will not cut the dividend. In fact, as early as last fall into Christmas, they were saying they would not cover the dividend in 2025. Well, here we are, first quarter 2025, and they're cutting the dividend. They sold their MSALA Sports. They bought some cable provider in the West Coast of the U.S. Was that a good allocation of capital? Who knows? The dividend's been cut by 56%. I think the street was looking for 50. Getting through all that noise, their business is very difficult. This is a very, very difficult business for a legacy communication company. Same with Rogers, all these guys, everyone's turning off linear TV. You've heard the story. So it's a very difficult environment for them. They have to try and rely on subs on their mobile network. Competition isn't getting easier there. So it's a very difficult game.
So hold it if you have it, I guess, but not necessarily a buy right now is kind of what I'm hearing.
So you've got a 6% yield.
Yeah.
It's at $31, $32 today, up from 29.5 when they announced. So it's had a nice little rally. Maybe it's a short covering. Who knows? I didn't say that out loud. But maybe it's actually real buyers coming in again and getting excited about the rebasing of BCE.
Okay. We are going to take another quick break. Michael Hakes sticking around, taking your questions today on U.S. and global stocks. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We have an email we're going to start with right now from Ryan. He says, can I get your guest thoughts on McDonald's? How is McDonald's doing? They reported recently.
Yeah, thanks a lot for the question on McDonald's. We don't own McDonald's in any of our funds and haven't done so for quite a while. It's a well-managed company, but super competitive environment out there for McDonald's. They've just, I guess, announced probably a weakness in the consumer. In the U.S. and around the world, actually, probably. For them, it's always about menu freshness. It's about same-store sales. It's about efficiency at the back end. It's offering delivery. It's offering in-house and online. And they've done a great job doing that, adapting to the environment over the last 30 years. So McDonald's is not one that I would recommend because we don't have 20% upside in our target price for that stock. It's probably more of in line with its earnings growth, which is probably 5 to 7% on that same store sales number that they project going forward.
And do you think that they will continue to suffer from a flagging consumer sentiment, consumers putting more money, leaving more money in their pockets this part of the year with the uncertainty?
100%, especially when you look at the U.S. specifically. When you look at mortgage rates in the U.S. over the last, 30-year mortgages in the U.S. are way higher than they were 2 years ago, 3 years ago. So as a percentage of that monthly spending that consumers have, it's much less because they're spending more on mortgages. So disposable income is key. Whether or not McDonald's is a staple or not is another question. They typically offer value meals at this point in the cycle where they try and entice traffic into the stores.
Okay. Let's go to another email then. This one's from AJ. He says, with all the global uncertainty right now, which we've been talking about, are we in a good buying position to purchase some of the larger cap tech stocks like Microsoft and take a long position? So we touched a little bit on this with the Tech 7 generally. You like Microsoft. Yeah,
we have a big position in Microsoft in our global growth portfolio. We like their positioning. They're growing their cloud business well. Their Copilot 365 Copilot offering is good and gaining some traction as all companies sort of adopt that kind of approach to the way they work their business in terms of efficiencies. Mm-hmm. And it's not very expensive. It's only $20 or $30 per head per user. So it's very reasonable that way in terms of the amount of efficiency you get. The amount of efficiencies you
get back from it, sure.
Exactly. Yeah. But we're in early days of that. But Microsoft is very well positioned. They're expected to grow at about 15% top line, maybe 15% bottom line, maybe a bit higher with some efficiencies, leverage in their model. So, but it trades at about 28 times, so it's not cheap.
Got it. Okay, let's get to another phone call then. Rob's on the line in Calgary. Hi, Rob.
Hi. Thanks for taking my call. I'd like to hear Michael's opinion on Pfizer. I've held it for a while now and written it down since COVID, and it looks like it might be testing a bottom. I also understand that they're refocusing on oncology drugs. And would Michael think that this might be a catalyst that might get the stock moving, or do you think there's better alternatives in the big pharma space? Thanks again, and have a good weekend.
Thanks very much. So Pfizer, of course, had its heyday during COVID with the vaccines and has been pivoting, I guess, to different avenues to try and raise money.
Yeah, that's Pfizer did so well during COVID. It's really seeing the unfortunate hangover from that. What they're working on now is an obesity pill, which I think they've actually just pulled back on that over the last few weeks. So that was a disappointment. So they're kind of starting from not scratch, but they have things in the pipeline that the caller alluded to. So there are opportunities on the horizon. We actually own it in our income growth portfolio because the yield is fairly high, and there's always opportunities in terms of that pipeline and things working there in their favor. So we like it here. It's fairly cheap. To Rob's point, it's hopefully hitting a bottom, knock wood. So we're positive on Pfizer, even though they haven't really. You can see the chart there.
I was going to say,
doom
I
and
was
gloom.
looking back at 2022.
Yeah, it's not. On that, you would probably say, "Oh, gee," but no, we still own it. Well, we're very patient investors, and hoping for the best for Pfizer.
Got it. Okay, we are going to take another quick break. When we come back, we'll have a look at Michael's past picks. Stay tuned for that. Welcome back. It is time now to take a look at Michael's past picks from April 19th of 2024, so over a year ago. At the time, Michael picked Kingfisher, which is out of London. We'll take a look at the numbers. 245.60 pounds recommended at, now at 302.20. So a 23% upside return and 29% total return upside. They're operating in 8 countries. They make home goods, I guess, home repair. Are they like Home Depot, essentially?
Yes, exactly. They're the Home Depot of the UK, France, and Poland. And when I recommended the stock last year, we had it in our income growth portfolio because it has a nice yield, as you can see, over 4%. The company was in turnaround, and it's actually still in turnaround mode, especially in France. They've been in France for a long time. Their margins are very, very low there, and they've been trying to turn those margins around to more company-wide margins in the 5 to 7% range. They have not been successful in doing that, but there's optimism for their success in that part of the business. They've also been they're also doing a lot of stuff behind the scenes in terms of operations, in-stock positions, doing very well there. The savings rates in France, for example, are very, very high, so that's put a lid on spending, consumer spending. So we hope with more certainty with the world, spending will increase in countries like France. Now we have the UK and the trade deal there, maybe there's more optimism there, so the stock is responding nicely. Do
you feel like the turnaround they've been working through has really helped them in this past little while to push things up as much as they have? Yeah, they have. It was depths of despair when we picked that stock. We had just met the management team. They talked to us about all their initiatives they were employing, and they're being very, very close to seeing traction in those. So we were optimistic. We had met their management team several times over the last 5 or 6 years, so we knew the story. We knew what they were telling us. We saw their progression, and we really felt that we should take an opportunity to name. You felt they were on the verge of something, yeah. Yes. Making that traction work. Okay, good to know. Let's move to your next past pick from April of last year, which is Starbucks, also undergoing a great deal of our sort of renovation, we'll say. They closed a lot of their stores. They want to refocus on people coming in and hanging out and a smaller menu. They're making a lot of changes. How's it going for them? Yeah, they want to bring that back to third place, so that's exactly right. I should just get in the numbers. So it was 87.61, down now to 81.17 American. So a 7% drop, return 5% drop. And would you say it's because of the restructuring they're doing? No. Well, if you put the chart up there, you'll see it's been a complete round trip. So in April last year, that was prior to the big announcement that Brian Niccol was coming on. Yes. So for those who don't know Brian Niccol, he was the superstar at Chipotle. He turned them around. Starbucks is a bit of a different restaurant chain because they're more mature, but similar issues.
So the stock got really excited, as you can see from the stock chart there, going up to almost 120 bucks on all his high-level initiatives he was going to put in place that he communicated to the investor base. Clearly, the stock is getting ahead of itself because those initiatives really take a long time to work through. You mentioned the food offering. My experience with the food offering is that muffin is about a 2-bite muffin, the blueberry muffin. If you notice that?
Yes.
If you were there 5 years ago, 10 years ago, that muffin was substantially bigger.
Yeah, the proportions are getting smaller.
It's a big weight out strategy at Starbucks. Anyway, they're revamping their food menu. They're simplifying it. They're bringing back the third place. They're making me pour my cream back in my coffee, which is great.
Yeah, everybody likes that control, of course.
We're very positive on McDonald's. We think that all his initiatives will gain traction over the next year or two. They've had to take costs up front to redo the stores and do the systems. So we're still very positive on Starbucks.
Got it. Okay, let's get to your third pick from last year, another pharmaceutical that was also got very well known during the pandemic, AstraZeneca. At the time, it was $68.55. It is now $68.26. So 0 on the return, and that's American, by the way, 2% upside for total return. What does AstraZeneca have going on? So
AstraZeneca's interesting story. The chart you can see there, I was doing great for a little while. Then where AstraZeneca was, they had some issues in China. Some of their employees in China were put under investigation. They had a little bit of a bad readout on one of their drugs, but that one drug had a lot of potential. But that readout was kind of, people took it very negatively, but they could have taken it more neutrally, but the stock did not like it. What we have going forward is AstraZeneca has a target of, in 2030, they have a target of $80 billion. In 2025, the catalysts are going to be, they have 28 readouts of phase 3 trials in this year. So that's crucial. That's a lot of catalysts that can come through over the next 8-9 months. That'll basically give visibility on 20 billion of that 20 billion of the new revenues that they're going to get. So that could be huge for AstraZeneca. It's not an expensive stock. It's not reflecting any of those kind of readouts at all now. So those were what we look for as we work through this year. And that's why we still own it.
Out of curiosity, are they focusing, as we talked about Pfizer, which moved away from certain things, backed off obesity, for example. Is AstraZeneca sort of moving in a certain direction that you see?
No, they have a nice broad suite of disciplines, whether it's oncology or respiratory or rare diseases. They have a great suite of offerings. So that's why we also like it.
Got it. Okay. Michael Hakes is sticking around to take more of your questions today on U.S. and global stocks. Stay tuned for that. We're back in a moment. Welcome back, and thanks for joining us. We want to go straight to your phone calls. Dominic's been holding on the line in Montreal. Hi, Dominic.
Yes, hello, Maria. Taking my call.
Go ahead.
I'm about Nvidia. I'm interested in Nvidia's price for the next 12 months, and given the announced chip sales restrictions as well as the tariffs, but also the easing back of these, I wonder what your best case, worst case scenario is on the stock price for the next 12 months.
Okay. Thank you for your call, Dominic. Pulling up Nvidia right now. So they're at 116-ish, I think. Yeah, 24. They are actually a little bit down today. There's been sort of in that range off its lowest low.
Yeah.
Of sort of about a month ago or so. What's your take on forward looking for Nvidia, considering the trade war? And yes, they have been stopped from sending some of their chips to China.
Yeah, Dominic, this is a great question. This is a name we've debated. We don't own today at Murray Wealth, but when we debate, we actually own Broadcom as a kind of a proxy for that whole chip build out. Nvidia is clearly the leader in the space. They have the Blackwell chip. Everyone loves it, and everyone pays a lot of money for that chip because there's no supply of any competitor or chips to knock them off that perch. And when you look, in order to look for Nvidia forward, you have to kind of look back and how successful they've been over the last 2 or 3 years, growing revenues by over 100% for the last 2 years. This year, I think it's supposed to be 50%. To the degree that the tariffs or the restrictions on chips can accelerate their sales is really unknown, going from what people are expecting 50% growth. And can it accelerate that? I'm not sure. That's the real question. And then the real question is how many competitors come in with chips that can compete with an Nvidia chip over the next 2 to 3 years. And that's really what we're facing in terms of competition and the risk to Nvidia. You mentioned upside downside risk. Well, there's a lot of risk to Nvidia if someone should come up with a chip that's comparable and can compete with an Nvidia chip, because then pricing comes off. And then, of course, we come to the end of the build-out of data centers and everything. And then we're to the next product cycle, which is what?
Next, yes.
Right. So
and did the DeepSeek thing throw you off as well on sort of support for or has that sort of corrected for you? DeepSeek was a big air pocket for everyone, and whether or not it's a real thing or not, everyone's kind of said it's a thing, but it's not a real thing. We're still going to have a lot of demand, and it'll be all fine. Is kind of the message. So they pushed that under the rug.
Yeah.
Okay.
Yeah. Whether or not it comes back out from under the rug is the next question.
You never do know. Okay. Let's go back to the phone lines then. We have on the line, I think, Anita, who's calling from Markham, Ontario. Hi, Anita.
Good afternoon. Thank you so much for taking my call. My question is on McKesson. I've done well on this one. My question to you is whether you see more growth and should I hold on to it or should I take the profit and buy something else? In this case, if you don't mind telling me what I should go to, I'll appreciate it. And Marella, could you please tell me what the Wall Street consensus is on this stock, please? Thank you so much.
Thank you. Sorry, I missed her last part of her question.
The consensus on the stock, I think she was looking for that.
That I will have to look up. But let's talk about McKesson. First of all, we'll pull up that chart. And she said she's done pretty well with this, so she's obviously been holding it for a little while. They're at $6.90, $6.54, so up just today, $6.29. What's your take overall?
McKesson is one I've known sort of from afar for 2 decades. It's, drug distribution. It's a volume business. Whether or not how much generic business there is, whether or not there's branded derivatives. So they're driven by many factors in terms of their top line. And you can see the stock has done pretty well. That's always been our concern, is that their competitive advantage is not huge, but they do act as a great intermediary between the drug companies and the final retailer. They've done a great job. So I wouldn't be in any rush to get rid of McKesson. They're slow and steady. That's what they're there for. They're not going to knock the lights out. So I'd be perfectly fine holding McKesson. Is
there a lot of competition, do you know, in this area?
There is. There's a couple of names who are their key competitors, but I can't remember their names off the top of my head. Okay,
but generally McKesson's pretty steady.
Yeah.
Got it. Okay, hang on to that one. I'll see if I can find the consensus as well. We're going to work on that. There we go. 14 buys, 3 holds, and 1 sell. So we hope, Anita, that answers your question. Let's go back to an email from Elle in Toronto. She says, I'm down over 40% in my shares in Abercrombie. Should I sell and take my losses or hold and wait it out? Abercrombie, of course. Clothing, I feel like it's an odd, I know Aritzia has done really, really well. And I'm wondering, clothing in general, retail in general at this period, what are your thoughts?
So that's a good topic to bring up because, yes, clothing in general is important and how you think about what the consumer is doing, but then it's also company specific. Abercrombie, mature, very mature company. It's been around forever. I remember when Abercrombie in the 90s was a growth company. Mm-hmm. They used to give us those beautiful brochures in the mail that were controversial. And some of that's got blowback now with the old CEO in court, but that's an aside.
Okay.
Abercrombie going forward is mature. They probably have very little square footage growth, I'm guessing. So it's really driven by same-store sales. And that's really the driver when you're talking about consumer sentiment and their freshness of their offering or who they're offering what to, in terms of the freshness of the product. Maybe it's also off because of tariffs. I'm not sure where they get their produt from.
Their sourcing, yes.
Which is also an overhang. So those have all worked against Abercrombie, as you can see from that chart, over the last 6 to 12 months. I don't know the valuation of the stock, but if you do have a path that zero to, let's say, no recession, but Fed's cutting rates or little recession, then this could be a good time to buy Abercrombie during a trough and depths of despair type of thing.
And be prepared to hold it.
Yeah, but going back to Aritzia and your comparison there, they are so early in their growth phase. They are underpenetrated in the U.S. dramatically. They have square footage growth for the next 5 years to the tune of 10 or 15%. If they can have also same-store sales of 5-6% on the back of that, then you're looking at a company that grow at 20% for the next 3 to 5 years.
Okay, so very different story,
Yes.
very different stage of the
Yes,
story.
even though they offer clothing.
Got it. Okay, we are going to take another quick break. We'll line up more phone calls for Michael when we come back. Stay tuned. Welcome back. We are going to an email from Ash, who says, what are your thoughts on the rail industry and CP Kansas City, in particular in the New York Stock Exchange? It is also a difficult time, I would imagine, for rail, considering some questions about trade and what's going to cross the border and what's not going to cross the border and get tariffed. What's your take on this rail? And I know they've got a good reach, but are they using everything these days?
Yeah, that's a great question, and thanks for the question, Ash. CP Rail, Kansas City. If you look at the stock over the last 5 years, has essentially been flat at a very narrow trading range, and it hasn't really gone anywhere. I think they bought Kansas City 2 or 3 years ago, and it's still in that trading range. And it's really had a headwind most recently from what you just mentioned in terms of all these trade issues. They do have, obviously, now they have complete contiguous market from Mexico up to Canada through the U.S. That should be fantastic. Once these trade deals are getting worked through and settled and worked through, so the visibility may be much better. CP specifically has pulled back their guidance for this year because of these issues. They were looking for initially, I think, 15% EPS growth, mid-teens EPS growth. They've pulled back to low double-digit EPS growth, so they've pulled up on that. Longer term, they would see probably high single-digit revenue growth, and probably a low double-digit EPS growth from a long-term perspective. So whereas before you saw them above that range for this year, they've had to pull that back. But I would be really positive on this company because of that contiguous market, because these trade deals will get done. People will still have to ship things back and forth. And you can see the stock up in the $100 range over the next 18, 24 months.
Okay, so this is something you would still be interested in, even though it's gone really...
Definitely.
Okay, got it, sort of longer term. Okay, let's get back to an email from David then. David says, can you please give me your opinion on Chipotle? Would it be a good buy here? We'll pull up that chart. You mentioned that the head of Chipotle has now gone over to Starbucks to try and revamp there and do what he did for Chipotle. Chipotle is actually down 22% over the year, now at $49.55. Have they been able to carry on sort of the changes that were brought into their restaurant business from their past leader?
Yeah, so that's a great question. When someone leaves, in this case, Brian, he had implementation in place. He was there for 5 years implementing all the strategies. So that does stick. Like, things don't change when someone leaves like that.
But you still need that persona to boost you.
Definitely.
Weekly, daily, to carry that on.
100%. You lead by example, so you need to be there and showing that you're doing it, because that will come away. But I think they hired someone who he hired when he was there to carry on his torch. So that's crucial as well. If they have the same style and approach culturally, then that'll be key. The stock is down because of all the headwinds in terms of economic concerns and macro concerns. Chipotle is still a very well-run company. Their operations are spotless.
And they're expanding too, aren't they?
They're still expanding. I don't know the growth rates, but they still have a lot of runway for growth. Hopefully, they don't start charging surcharges for their guac, because as we know,
that does very well.
I know.
Yeah. Okay, so they're expanding. They're seeing the downslide that everything else is seeing, but they're
Right.
them ahead for growth.
But as a quality company, when you see all these retailers and restaurants get hit on a macro concern, then it's really a great opportunity to buy those quality names that have been hit for the same reason, but are going to come out stronger.
Got it. Okay. I also wanted to ask just about investing strategy generally, because given the start of the year has been so, I'm going to say erratic, right? March, April, now into May, we see a bit of a settling down, but we don't know for how long. How have you changed the way you are investing, or have you changed your approach to investing? Yeah,
that's a great question, because people will change their stripes as they get affected by different things. And as I mentioned at the early part of the show, once in a 1,000-year president has been dramatically changing a lot of things.
Blowing things
neutral, for literally blowing everything up, whether it's funding for research, challenging universities, everything. But we haven't changed our approach. We look at everything from bottom-up perspective. We have target prices on all our stocks that we have in our portfolio, which is concentrated 32, 33 names. So we know them all very, very well. We have target prices, and we also have our target weight on our portfolio. So if we're 3% in our AstraZeneca, for example, and because it gets hit, and as we saw last year, and it goes down to 2.5%, 2%, then we'll have a debate amongst our team whether or not we should buy it up. So every name in the portfolio goes through that process. So while we are being affected by the macro, our process doesn't change below that. If something is getting overly put in a penalty box because of those macro concerns, we'll readdress our bottom-up thesis as to how that company management team is addressing what's going on from a macro perspective.
I think part of the challenge is when you get a macro change, you expect a macro change that then lasts for some time, whereas now you're getting sort of this macro change by decree that 48 hours later will be reversed or pulled entirely or changed to look very, very different. You don't know where you're going to get hit, and you don't know when you're going to get hit next.
That's right. It was like changing. Everything was being changed every 48 hours in terms of the messaging from the White House. It was or the Golden House. Mm-hmm. So it was just a disaster for everyone. But we found that no matter through all crises, whether it's COVID, this crisis, or the great financial crisis, if you take that same bottom-up approach and look at stocks on an individual bottom-up basis to see how that company is affected, because every company has a geographical difference in terms of exposures. Mm-hmm. They have sector exposures which are different. Their management team may be reacting differently to exposures. That's the way you can really come out of this ahead of it.
Okay, so where is the advantage you see if you were to give an investor sort of an overall piece of advice? As you said, this is a time, 1,000 years. We have not seen a president like this. He's blowing things up. Where's the sunshine in that? Where's that silver lining in that?
You hope for some normalcy or a return to not the norm, but it's just it can't survive in this kind of a state. Uncertainty. No business can manage their way forward until they know what the rules are, and that's the same with us. You have to hope that the rules will come into place, and we'll go forward from there.
Given that, then, are you planning for 4 years of uncertainty, or are you literally thinking things will sort of straighten out a little bit more in 2025 and it'll be par for the course?
Well, that's the key. Is that unfortunately, we're gonna have 4 years of this.
Okay.
When we look into 2026 and we have the elections, the midterms.
Yes.
So that's going to be the key. Does the Democrats take the House or the Senate or a combination thereof? And then the Republicans will lose some power. We also have some lawsuits coming through through the summer in terms of challenging all the terrorists, how they brought him on. By the way, he said it was an emergency.
Yes, under national security.
Yes. So that'll come out too. So there are a lot of catalysts that could potentially work into investors' favors until walking back a lot of these issues that have been brought up.
Got it. Okay, we're going to take a quick break. We're going to share Michael's new top picks. When we come back, stay tuned. Welcome back. Thanks for joining us on Market Call. We're going to take a look at Michael's new top picks. We're starting with United Health, New York Stock Exchange. United Health, we've heard about for a while. I'm just wondering why you like it as you move forward.
Yeah, great question. We like it because United Health has been the bastion historically of consistency, and we just saw last quarter where it has become inconsistent. What happened in the last quarter is the management team had seen, they have a part of their business is Medicare Advantage.
Okay.
Every year they try and gauge utilization rates, how many times you or me go to the doctor, go to the hospital, go to outpatient services, go to inpatient services, use x-rays, et cetera, and they devise their pricing for each of those people, depending on our bucket, how old we are, all our health, our metrics. So in the last quarter, sort of out of the blue, because they're usually very, very good at guiding for the rest of the year, they took a big hit, took a 12% guidance down in terms of EPS, because those utilization rates, mainly for seniors, had gone up for patient visits to their GP and outpatient care. Kind of an anomaly. And they guided to that this is going to work, this is going to be a hit for the remainder of the year and maybe into 2026.
Interesting. And they don't really have a reason for that? It wasn't an obvious reason for that?
It's really utilization rates and seemingly their inability, even though they have a lot of data going back in time in terms of every January, February, given this cohort, this isn't what people use. And there's a feeling, there's a bit of for some reason, a continuation of the uncertainty that's been driven by COVID and other things. So they took down guidance by 11, 12%, and the stock was down 20%. So if you look at 2026, for example, earnings for that year were 38 3 weeks ago, and now they're 30. But even if they can show some traction back in terms of that utilization rates more normalized over the next 8 to 9 months, then the stock is going to have a huge rally. Even if they can earn $30.26, and you put a more normalized multiple on that of 17 times, the stock could be back to $500.
Okay, so a good time to dip in if you're wanting.
Yeah, for a company that has a 20-year track record of excellent execution, they have excellent knowledge in the business, they have very, very few hiccups. This is a great time to buy.
Got it. Okay, let's move to your next topic, which is Accenture, which is specializing in sort of strategy consulting, but if you can expand on that, what do they do?
Yeah, definitely management consulting. They help companies with their operations, their new technology rollouts. They help with processes for small, medium, and large businesses globally. Very well known for that. So in 2024 and early 25, most people were just beta testing their Gen AI and Gen AI agents within their businesses. It's now just starting to gain traction. And people need a lot of help when they execute rolling out their Gen AI and their agents internally to help with the productivity gains. And Accenture is at the sweet spot of that revenue. Well, they're going to be seeing lots of revenue growth over the next 3 to 5 years as people want this expertise that Accenture offers. And no one's going to be able to not do this, because it's so powerful in terms of your productivity and efficiency when you roll these programs out that just as table stakes, you're going to have this capability.
Yeah, you'll be left behind if you
yes,
don't.
Yeah.
Got it. Okay, let's go to your next topic then, which is a luxury brand, LVMH, out of France. How are luxury brands doing generally? This is a fairly wide banner.
Yeah, So LVMH specifically has brands that we know: Tiffany, Bulgari, Sephora, and 75 other well-known brands. They are the behemoth in luxury goods, and they're the kind of the benchmark. The stock has been very weak as they've seen the consumer pull back globally, whether it's in China, which is a very important market for them. Even the U.S. last quarter was weaker than people expected. But historically, over all these cycles, their brands have performed very, very well. The returns on invested capital for LVMH are very, very high, and they have been able to sustain these returns on invested capital even through weak times, whereas more niche luxury brands would have huge variations in their return on invested capital. It's important to have a sustainable returns on the capital, and in terms of its multiple today, it's very cheap. It's about 17 times earnings. Yes, it's probably growing zero this year, but we expect once the tariffs come through, we have it's that whole visibility thing. Rates come down, we'll be very bullish for the global luxury market.
And generally, how have they been able to succeed so far when other smaller luxury brands haven't been? Is it just the strength of having so many banners?
Yes, it's a leverage among the brands. They can allocate capital between brands depending on how they're doing, whether or not they have more new product launches for specific brands and how much marketing support they want to give behind those. And they're very good at that.
Got it. Okay, we do have to leave the conversation there. Michael, thanks for coming in. Have a good weekend.
Yeah, thank you.
And that is it for us here on Market Call. We'll see you again on Monday. A quick look at the markets in North America as we head to a break. Have a great weekend.